Obviously, a big debate around some of the strategies that you've pioneered, strategies that for a lot of years were kind of up against the wall here, strategies that at least right now seem to be back in vogue.
Yeah, thank you for inviting me on, and thank you for asking that question. When we wrote a paper back in 2016 called "How Can Smart Beta Go Horribly Wrong?" And the essence of the paper was very, very simple. If you have a stock that soars and its underlying fundamentals don't, its past returns will look great, but if there's any mean reversion, watch out. Everybody knows that. Now, you can say the same thing about factors and strategies. You can have a quality strategy that anchors on companies with the highest quality of earnings, with the highest profit margins, that sort of thing. You can have a momentum strategy that anchors on stocks with the best momentum. You can have a value strategy that prefers cheap stocks. And all of these have some sort of normal valuation. So quality always trades at a premium multiple. It always trades to reflect the fact that higher quality is desirable. But if it's trading at a 40% premium to the market or 100% premium to the market, that makes a big difference. And so the essence of the 2016 paper was, watch out, values sensibly priced, outside the US, values cheap, but some of these other factors are trading at unusually high levels of valuation. Low beta was very popular in the aftermath of the 2015 difficult market.
Right.
And so low beta strategies were trading at the richest relative valuations in history.
Yeah.
And our cautionary note was, just like stocks that get ahead of their fundamentals, a factor or a strategy that gets ahead of its fundamentals is in trouble. Well, today, we're in the opposite situation.
I am curious, Rob. I mean, the paper you're referring to, of course, I think caught everyone's attention, at least in the world of finance. And, of course, it's been a big topic of debate ever since. There were a lot of the, I guess, criticisms around some of those ideas didn't necessarily seem to be your underlying thesis. It had more to do with the idea of trying to time the in and outs into those factors.
It's interesting. The debates, the controversy weren't really debates per se. I have never been an advocate of aggressive timing of factors and strategies. I've always been an advocate of broad diversification and even style diversification. Use multiple factors, but lighten up on the ones that are trading rich. Put a little more emphasis on the ones that are trading cheap. And it strikes to me that that's kind of a banal suggestion. So I was amused that it was so controversial. But like I said, if you have a stock that's gotten ahead of its fundamentals, its past performance will be great, and if there's any mean reversion, it's in trouble looking to the future. So does that mean you go entirely out of that stock, or do you go entirely into a single stock that is trading abnormally cheap? Of course not. Diversification is important. And the same thing holds true for factors and for strategies. Use an array of strategies, but make sure you're not over relying on ones that are trading rich. Well, the beautiful thing today is that most strategies are trading cheap relative to history.
Let's talk about some of those strategies, because you make the point in this paper released this month that really you're bullish for the mirror image of the reasons that you were, cautious in 2016, 2017. Of course, now we're in an environment where a lot of these factors, to your point, are maybe trading cheaper than they have been. Let's get specific here. What of the factors are trading the most cheapest? That's not great grammar, but trading the cheapest to maybe what the fundamentals actually are.
Well, there's a bunch of them. Low beta, which is a risk-averse strategy, a focus on low volatility stocks, is trading abnormally cheap in the US and in emerging markets, not so much in international developed economies. Quality, the notion of buying high profit margin companies, is trading rich in the US and international markets. So that might be one you want less emphasis on. Value is trading dirt cheap in the US and in emerging markets. So value seems to be worth a little extra attention. The point of this is not load up on the strategies or factors that are trading abnormally cheap and shun the ones that are expensive. The point is, you might want to ramp up your exposure. The beautiful thing in today's market is that most factors, in the paper, for instance, we track 19 factors around the world. 11 of them are trading in their cheapest quintile ever, meaning cheaper than 80% of the time historically. That's aberrant. And that tells me that multi-factor strategies are, in large part, cheap and worth special commitment. Multi-factor has been falling out of favor. It's had negative flows the last 3 years for a good reason. The performance was lousy. But from today's markets, on a forward-looking basis, I would say that the outlook for returns for multi-factor are terrific. And people who are thinking of pulling out should think again. People who have too little exposure to these strategies ought to think about whether this is the right time to ramp up.
So, Rob, multi-factor strategies look terrific in your words, but I want to dial in on one factor because you mentioned that value is looking particularly cheap here, but I'm hoping we can get a bit existential because what is the certain makeup of a value stock in this market? To me, it used to mean energy, financials to some extent, but what is the common characteristic of value companies right now?
Well, the common characteristic is less about industries and sectors than it is about attributes. These are companies with lower price to book value than the broad market, lower price earnings ratios, lower price to sales. Price to sales gets way too little attention. It's a really powerful measure. Price to dividends plus buybacks, another very, very useful measure. So when stocks are collectively, a group of stocks are collectively cheap on those dimensions, that's a value portfolio. And value in 2020, in August of 2020, was trading cheaper relative to growth than ever before in its history. Or put a different way, the FANG bubble stocks in August of 2020 were more extravagantly expensive relative to value than they were at the peak of the dot-com bubble. Wow, that represents a great opportunity. So the snapback in value in the last 2.25 years has been tremendous, but they're still cheap. They're no longer cheapest ever. They're in the cheapest quintile, cheapest 20% of all historical experience. That's a terrific time to embrace value. And there are other factors, unlike 2016 when most factors were trading rich. Today, most factors are trading cheap.